Hello and welcome to Mokoya Finance. My name is Zaradeen and I will be your finance tutor in this class. In this class, I will explain some components of balance sheet, examples of these components, and important things to take note of while reporting these components on the balance sheet. The first item is cash equivalent. These are highly liquid short-term investments that are very close to maturity, that there is a minimal risk that their value will change with changes in interest rates. Some examples of cash equivalents are demand deposits with banks, highly liquid investments such as the US Treasury bills, commercial papers, and money market funds with original maturity of 3 months or less. However, these excludes amounts that are restricted in use for at least 12 months. Next is marketable securities. These include investments in debt and equity securities that are traded in a public market and whose value can be determined from the information that is available in a public market. Examples are treasury bills, notes, bonds, and equity securities such as common shares and mutual fund shares. Next is account receivables. These are the amounts owed to a company by its customers for products and services that have already been delivered. An important concept here is the contra account, which estimates the amount of receivable that is uncollectible and therefore reduces the account receivable to a net value. It is important to note that significant increase in account receivables relative to sales is a signal that the company is not able to collect cash from its customers. Next is inventories, and these are physical products that would be eventually sold to customers as either raw materials, work in progress, or finished goods. The cost of inventory comprises cost of purchase, conversion, and all other costs that were incurred in bringing the inventory to its present location and condition. Next is other current assets. An example of other current asset is prepaid expenses, which is a normal operating expense that has been paid in advance. Expenses are recognized in the period in which they are incurred and not necessarily when payment is made, and therefore a payment for a future expense creates an asset. On the liability side, we start with account payables, which is the amount the company owes its vendors for purchase of goods and services. An example is the unpaid amount for purchase of raw materials on credit. Significant changes in account payable relative to purchases could signal potential changes in the credit relationship between the company and its suppliers. Note that the current portion of long-term liabilities are also reported in the current liability section of the balance sheet. Next is accrued expenses. These are expenses that have been recognized in the company's income statement but have not been paid as of the balance sheet date. Examples of accrued expenses are tax liabilities, accrued interest payables, and wages payables. Next, we go to non-current assets and we start with properties, plant, and equipment. Properties, plant, and equipment are tangible assets that are used for a company's operations and are expected to be used for over one fiscal period. Examples of property, plant, and equipment are land, building, machinery, furniture, and natural resources. An important concept under property, plant, and equipment is depreciation. This is the process of allocating the cost of a long-lived asset over its useful life. An impairment occurs when an asset's recoverable amount is less than its carrying amount on the balance sheet. Here, a loss is recognized in the income statement in the period in which the impairment is identified. Note, while depreciation is the allocation of cost over a useful life, impairment is an unanticipated decline in value. The next non-current asset is investment property. This is a property used to generate rental income, capital appreciation, or both. And then we move on to intangible assets. These are identifiable non-monetary assets without a physical substance that are recognized on the balance sheet when it's probable that future economic benefit will flow to the company and can be reliably measured. Examples of intangible assets are licenses, trademarks, and patents. The next non-current asset is goodwill. Goodwill is the excess of purchase price over the fair value of identifiable assets and liabilities acquired. Examples of goodwill is good reputation, established distribution system, trained employees, as well as R&D. Next, we move to non-current financial assets. These are contracts that give rise to a financial asset of one entity and financial liability or equity instrument of another entity. An example is investment in stocks, bonds, notes, and fixed income securities issued by another company and derivatives. The next non-current asset is deferred tax assets. This asset is created when the actual tax payable based on income for tax purposes exceeds the amount of income tax expense on the reported financial statement as a result of timing differences. For example, a company may be required to report a certain income for tax purposes but defer the recognition of that income in its financial statements till future periods. Next, we move to long-term liabilities, and these are liabilities with maturity over 12 months. Examples include loans, notes, and bonds payable. The next non-current liability is deferred tax liability. This creates a liability when the actual income tax payable is less than the income tax expense on the financial statements. An example is when a company uses accelerated depreciation for tax purposes and a straight-line depreciation for financial statements. Another example is when a company's subsidiary has profit that has not been distributed and therefore not taxed. The first item on the equity section is common stock. This represents the amount contributed by the company's owners. The number of authorized shares is the number of shares that could be sold by the company under its article of incorporation. And the number of issued shares refers to those shares that have been sold to investors, while the number of outstanding shares is the number of shares that have been issued less the number of treasury shares of the company. Next is preferred shares. These can be classified as either equity or liability based on their characteristics rather than their legal form. For example, perpetually non-redeemable preferred shares are characterized as equity, while preferred shares with a mandatory redemption at a fixed price are classified as liabilities. Preferred shares take precedence over common shares when it comes to dividend payment or receipt of asset in liquidation. Treasury shares are shares that have been repurchased by the company and held rather than cancelled. Note that these shares can be resold by the company. Retained earnings are the cumulative amount of earnings that have been recognized in the company's income statement and have not been paid to the owners of the company as dividend. We also have other reserves, also known as other comprehensive income. Comprehensive income includes net income, which is recognized in the income statement and reflected in retained earnings. Other comprehensive income is not recognized as part of net income and is reflected in accumulated other comprehensive income. And the last item is minority interest, which represents interest of minority shareholders in subsidiary companies that have been consolidated by the parents. And this brings us to the end of this video segment. In the next video, I will walk you through how to build a balance sheet from scratch. If I have in any way made you understand the components of balance sheet better, please hit the subscribe button and follow my channel in your quest towards becoming a finance expert. See you in the next video.